Good afternoon, everybody. Uneducated Economist here. So I was just reading this Wall Street article, and it really got me thinking about some stuff. Like, a lot of times I like to read an article or maybe take a particular opinion that somebody has and really run with it. Like, really let my mind just kind of like let the conspiracy theory just go, and really try and see how far and how deep I can really, come up with some crazy, wild things. And I try to keep it as realistic as possible. And sometimes I just think, man, is this really what's happening? When I think of something, like, I kind of imagine these scenarios that are coming up. And one of them right now, and I really it kind of really solidified it, my idea here, when I read this Wall Street article, talking about the interest rates or the yields rising on the 10-year Treasury, and how Jerome Powell found that to be shocking how quickly it moved, but that it wasn't concerning until it becomes disorderly. Now, that I found very interesting, because the way they were talking about that, this disorderly situation within the U.S. Treasuries, or what it could do to the financial markets out there. Basically, his concerning approach is where it starts to affect, like, the flow of credit to households and businesses. Now, I'd assume that's what all Jerome Powell was saying. But I thought about that. It was just like, until it becomes disorderly, or as long as it's not disorderly. And I'm thinking, wow, you're kind of almost anticipating this happening. Like, you're allowing it. And this is something that we have talked about in previous videos, that the Federal Reserve is going to allow the interest rates to rise on the long-dated treasuries, especially like the 10-year. The 10-year dictates where all interest rates go. Now, it doesn't set the interest rates by any means. Somebody had brought that up in the arguments, or as an argument in the comment section. The 10-year does not set interest rates, but all loans follow where the 10-year goes. So if the 10-year starts to tick up in yield, then mortgages, car loans, everything out there, those interest rates are going to start going up as well. Wherever the 10-year goes, all interest rates go. And right now we're seeing a very odd thing taking place, where the short-term treasuries are dropping and the long-term treasury yields are rising. And this is because people are fearful of the future. Now, Janet Yellen doesn't say that. Janet Yellen is saying that people are very hopeful of the future. And that's why you're seeing, they're expecting, like, good economic conditions coming into the future. That's what she is saying. I have a feeling that they are fearing inflation. Why? Because for the last 6 months, the Federal Reserve has been saying, we are going to let inflation run hot for extra long, for an extra period of time. So everybody is anticipating that there's going to be inflation coming, and now we're starting to see that perception, that inflation expectation is starting to come up, and you're seeing it in those long-dated treasuries. So this has really created a very peculiar situation inside of the bond market, because the U.S. Treasuries are like the safest secure asset in the world. Like, there is no doubt that they are going to go into default. The Treasuries from the United States guaranteed to pay no matter what. So they are very, very, very safe. You can start stepping into higher risk, and when you get into very high risk, you're talking like junk bond status. These are from the corporations that are very risky out there, meaning that they're setting up for, possible, conditions in which that they may default on them. That's why they're high risk. Just like anything that if you have really bad credit out there, you're not going to get the best interest rate on your house loan or car loan. Same thing with these corporations. But something interesting is happening right now, because the bond investor who is looking for fixed income has turned into a speculator, because interest rates continue to drop into the future. As far back as you want to go, it almost seems like there has been continuous dropping of interest rates, especially in the U.S. Treasuries, since the early 80s. They have this condition in their mind that there is no way that interest rates will rise on these things, or that the yields will go up. And when yields work inversely to price, that means the price comes down. So the bond investor has turned into the speculator, anticipating yields are going to go down into the future, and they'll be able to sell the bonds that they had purchased for a profit as the price goes up. But when the interest rates begin to rise, all of a sudden, the bond investor doesn't look at the price that they can sell it for, because the yields are rising and the price is dropping. They will not be able to sell it for a profit. Now they have to turn to yield again. They have to look at it and say, oh my gosh, I want yield. I need a return on my money, or I won't be able to tie it up for very long. So that's why you're seeing the short-term treasuries dropping, is because the investors are getting into that position so they do not have to tie up their money very long. They can get it back in a month or 3 months. And they're worried about the long-dated stuff. That's why they're not getting into the 10-year and longer treasuries. It's because they're fearful of the inflation, and if they tie their money up that long, then they'll get their money back and they will not have the purchasing power that they have right now. So this is why you're seeing this steepening of the yield curve, where the short term is dropping and the long term is rising. And now in this article from Wall Street, they talk about the disorderly conduct, something going disorderly. And so I'm thinking, okay, well, eventually what's going to happen here is that those 10-year treasuries, or just the long-dated treasury, I shouldn't just say the 10-year, but the long-dated treasuries are eventually going to step up to a point where they are more attractive than the junk bonds are. See where I'm getting? Like, it doesn't have to match it. It just has to get to a point where the investor no longer wants the junk bond. Says, yeah, I mean, all of a sudden the U.S. treasuries are now looking more attractive. I can move over into that position. Now, this is going to create a very, very difficult time for these zombie corporations that are out there. Zombie corporations cannot exist unless they are able to take out ever-increasing amounts of debt that is cheaper and cheaper. And they are able to do that all the way up until pretty soon. Like right now, they're able to still get these incredibly low-yielding bonds sold into the market only because everybody is so fearful of the inflation coming in the long-dated, in tying their money up in the long-dated treasuries. So they're looking for that yield. They're finding it in those junk bonds. But eventually it reaches that point, that tipping point. And then people will not want those junk bonds. Those corporations are going to be sucking. They're going to be like, oh my gosh, what do we do? And they're going to start selling their own debt or their own stock off to pay for their debts, or start laying off employees or doing something to try and keep from going into default. And it's kind of interesting, like if you go and you watch China, like China is like ahead of the game. They were the first of everything. Like they were the first to get the COVID, first to lock down, the first to open up, the first to, to have the economic recovery. Everything was first. And if you go and you look over there, there came a point where there was too much liquidity in the system. And they had to start pulling that out. And when they started trying to pull that out, it caused a bunch of companies, corporations to start to default. That very same thing could happen here. And that's what I think Jerome Powell was talking about when it becomes disorderly. Because at some point, these zombies are going to have to die. And right now, the Federal Reserve could be put into a point where they could go on a zombie hunt. All they have to do is continue to say that or at least give the impression out there that inflation is going to continue into the future. And those U.S. treasuries will eventually rise to a point where they're more attractive than the junk bonds, and the junk bonds will have to figure out a way to start living without it, and they can't. All those zombie corporations will be in bad spot. And it's not just them. There's zombies in all kinds of stuff. You got zombie, like, mortgages. Zombie, think about all the people right now who are working for these zombie corporations who are paying rent. All right? I mean, all this stuff is like, it's on the verge. And the only way to keep it going is to drop interest rates, which could eventually lead to a destruction of the system. So right now, what we're coming into is a very, at least in my Austrian economics way of thinking, is they're about ready to start burning the undergrowth. Once you burn all that out, then you can have an economic expansion. But when you have all these zombies sucking off the system, taking all the best talent, taking all the best resources and producing nothing with it, and actually draining on the system, then yeah, you'll forever. I mean, it'll forever be a struggle. But if you can get rid of those guys, now you can have prosperity again. So I kind of wonder sometimes when I read some of these articles like this, if I don't think like the Federal Reserve might just go on a zombie hunt and just let the interest rates rise. And, even think about it, like yield curve control is a form of credible threat. It's one of their tools, but it's more of a credible threat than it is an actuality of what they're going to do. Because what they're going to say is they're going to pin a spot on the U.S. treasuries, and they're going to say, hey, we're not going to let the 2-year go above a particular yield. and they're going to cap it. And they're going to buy as many 2-year treasuries as it takes to keep the yields from rising on it. And when the market hears about that, they're going to jump out there and they're going to front run the Federal Reserve and try and buy up those 2-year treasuries before they have a chance to do it. Now, this is the same thing that happened way back in the day when they did yield curve control after World War II. I mean, go and read some of the documents. That's essentially what happened. They did participate in the market. They will buy some, but it's the credible threat of it. That's what they're looking for. And so now when I think about this for just a second, just the idea of introducing yield curve control is a credible threat within itself. Before they even, like, the markets will react to the news of there being a possibility of yield curve control. And I would assume that the market is going to say, we are going to wait until they actually announce yield curve control. And by waiting, it's going to cause the yields on the long-term treasuries to continue to rise as they anticipate the Federal Reserve to, enact the yield curve control, to start using it. So just the threat of it coming is the credible threat that's getting the markets to do stuff. Once they enact it, then the markets will behave in a different fashion. They'll be like, okay, let's go out and front run the Fed, now that they have stated that they are definitely going to do this yield curve control. You see, it's like, they can control the markets just with their words, just by giving the idea that they're going to do something out there. So yeah, I don't know. You guys let me know. Is the Federal Reserve about ready to go on a zombie hunt?